We're approaching one of those uncommon market moments where everything converges perfectly. Investors who identify this opportunity right now in January 2026 will look back 12 months from today feeling grateful they took decisive action. What I'm presenting isn't conjecture or sensationalism. These are 5 corporations that have fundamentally transformed their business approaches in ways most market participants haven't fully comprehended yet, and the financial metrics are demanding our attention. If you've been hesitating on the sidelines wondering when to enter, this could be the opportunity you've been anticipating. Before we explore these opportunities deeply, do me a quick favor. Subscribe and activate notifications for finance. Because we'll be monitoring these investments throughout 2026 and you won't want to miss the updates. Believe me, the knowledge we provide here could genuinely alter your financial path this year. Stock number 1, Oracle, the AI infrastructure powerhouse. Let me begin with something potentially surprising. Oracle. Now, I anticipate some reactions. Oracle, isn't that simply legacy enterprise software? Not anymore. What's occurring with Oracle presently is a complete metamorphosis that Wall Street is only starting to comprehend. They're transforming into an infrastructure titan in the artificial intelligence arena. And there's a particular catalyst approaching on January 22nd that could significantly impact share prices. Oracle is finalizing an arrangement where they're acquiring a 15% equity position in TikTok's U.S. entity alongside Silver Lake and MGX. But here's what matters beyond the headlines. This arrangement secures Oracle as the exclusive cloud provider for all TikTok's U.S. user data. We're discussing massive recurring high-margin revenue that validates their entire sovereign cloud approach. Now, shares retreated in December because investors grew anxious about Oracle announcing a $50 billion capital expenditure plan for 2026, but Intelligent Capital views this differently. The capital is constructing the Stargate AI supercluster with OpenAI, and the figures are absolutely staggering. Their remaining performance obligations essentially contracted. Future revenue surged 438% to $523 billion. Consider that momentarily, $500 billion in backlog revenue. The market temporarily discounted this because people concentrated on short-term spending instead of long-term dominance. Multiple Wall Street institutions have recently issued aggressive price projections. Guggenheim established a street-high target of $400. TD Cowen went to $350, and Bank of America sits at $300. These aren't minor adjustments. They're recognizing that Oracle's cloud infrastructure revenue exploded 68% year-over-year to $4.1 billion. And they're capturing AI workloads from Amazon because their GPU clusters are both faster and more economical. Management has officially guided for $104 billion in revenue by 2029. If you're purchasing in January 2026, you're entering at the early phase of a multi-year doubling of this corporation's scale. Stock number 2, Shopify, the global retail operating system, moving to the second opportunity, and this one is absolutely captivating if you comprehend where commerce is heading. Shopify has evolved far beyond merely being an e-commerce platform. They've become the global operating system for retail, and there's a product cycle happening right now that most people aren't monitoring. Their Winter 26 edition just launched, and the adoption of their new agentic AI tools, specifically something called Sidekick, is accelerating faster than analysts anticipated. Wall Street is forecasting conservative mid-20% growth rates, but the reality on the ground tells a different narrative. Shopify's international expansion is absolutely exploding. European gross merchandise volume surged 41% recently, and they're maintaining an 18% free cash flow margin that has now persisted for 9 consecutive quarters straight. Here's what makes Shopify genuinely interesting for 2026. They've developed agentic storefronts that insert merchant products directly into AI conversations on platforms like ChatGPT. This creates a completely new high-margin revenue stream that traditional retail competitors simply cannot replicate. And the timing matters because their Q4 earnings are arriving in February. Institutions are positioning before that release. Wells Fargo maintains an overweight rating. Seaport Research raised their Q3 2026 EPS estimates, and the consensus from 10 major analysts shows strong buy ratings with street-high targets pushing toward $210 in their most recent quarter. Shopify delivered $2.88 billion in revenue with 32% year-over-year growth. Their adjusted EBITDA surged to $470 million, up 16% year-over-year. Full year 2025 revenue hit $14.5 billion, a 29% jump. But here's the kicker. Analysts are predicting 20 to 30% revenue growth for 2026, and that's probably underestimating the B2B and international segments, which are growing even faster than the core business. If you're finding value in this breakdown, drop a comment below and let me know which of these stocks you're most interested in. I read every comment and often create follow-up content based on what you all want to hear more about. Stock number 3, Sophie, the fintech transformation story. The third stock I want to discuss is one that has been absolutely crushing it, but still doesn't get the respect it deserves. Sophie has completed one of the most impressive transformations in fintech. They've gone from being just a challenger bank to a legitimate financial powerhouse. The proof is in the numbers, 8 consecutive quarters of GAAP profitability. That's not adjusted earnings or accounting tricks, that's real sustainable profit. Their Q4 earnings are coming in late January 2026, and it's expected to confirm that their financial services productivity loop has reached escape velocity. The hidden opportunity with Sophie that most people are missing is something called the Galileo platform. Think of it as the Galileo powers the infrastructure for other banks, which means Sophie is diversifying revenue away from just lending and into high-margin software services. Then in December 2025, they launched their Sophie USD stablecoin and re-entered crypto trading. This unlocks another high-margin revenue stream just as digital asset sentiment is peaking. The stock nearly doubled in 2025. But here's why it's not done. The P/E multiple sits at 48x, which actually looks cheap for a company growing revenue at 38% year-over-year with expanding margins. You're essentially buying a bank that trades like a tech company right before their student loan refinancing business is about to experience a multi-year renaissance due to shifting federal policies. Institutional money is quietly loading up. Vest Investment Advisors just disclosed a new $6.72 million position. Motley Fool named Sophie a top growth stock, citing their one-stop-shop ecosystem. 5 major analysts now rate it a strong buy with price targets drifting toward $27-$30. And street-high targets are reaching $38-$40. In Q3 2025, Sophie posted record-adjusted net revenue of $962 million, up 38% year-over-year, crushing the $880 million consensus estimate. Adjusted EBITDA hit a record $277 million, up 49% year-over-year. That margin expansion as they scale is the hallmark of an exceptional business. For 2026 specifically, analysts project the new crypto stablecoin segment could add over $100 million in high-margin revenue. Student loan refinancing is projected to rebound significantly as federal policies create clarity and drive borrowers back to private refinancing, which is a core Sophie strength that's been dormant for 3 years. Total members hit 12.6 million, up 35% year-over-year, and crucially, 35% of new products were opened by existing members. The cross-sell machine is working perfectly. Give this video a like if you're seeing the value here. It helps more people discover this content, and honestly, these opportunities deserve to be shared with as many investors as possible. Stock number 4, NVIDIA, the AI economy bedrock. Now we're getting into the heavy hitters. NVIDIA, this is the company that's basically become the foundation of the entire AI economy, and the numbers are almost hard to believe. Their data center revenue now accounts for 90% of total sales. In their recent Q3 fiscal 2026 report, NVIDIA posted $57 billion in revenue, up 62% year-over-year. The data center segment alone generated $51.2 billion. Looking ahead, guidance for Q4 projects revenue to hit $65 billion, and analysts forecast fiscal 2027 revenue to soar nearly 48% to over $316 billion. This isn't slowing down, it's accelerating. The Blackwell architecture is the key catalyst here. Current backlog sits at 3.6 million units and it's reportedly sold out for the next 12 months. On top of that, there's a fresh surge of 2 million H200 chip orders from China following recent export authorization. The next generation Rubin architecture is slated for late 2026 launch, and major customers are already pre-ordering to avoid the long wait times they experienced with previous architectures. Here's what makes NVIDIA truly compelling right now. The stock is trading at a forward PE of roughly 24x. That's a significant discount. Compared to its historical average of around 60x, you're getting hyper-growth at a relative value that we haven't seen in years. Wall Street sentiment has shifted from cautiously optimistic to aggressively bullish. Evercore EC has a street-high target of $352, citing insatiable demand for sovereign AI clouds and a $500 billion order backlog. They view NVIDIA not just as a chip company, but as the operating system of the new economy, predicting 85% upside from current levels. Bank of America's Vivek Arya maintains NVIDIA as a top pick for 2026, highlighting that NVIDIA's software moat CUDA Plus enterprise AI is expanding faster than competitors can release hardware. Cantor Fitzgerald made NVIDIA their singular top pick for the semiconductor sector, emphasizing that the scarcity gap for Blackwell chips won't close until at least mid-2027, giving NVIDIA unprecedented pricing power and margin protection. Management guided Q4 for $65 billion in revenue, which would bring the full fiscal year to approximately $187, $213 billion, depending on final adjustments. That's a staggering jump driven almost entirely by the data center segment. For fiscal 2027, consensus estimates are now modeling revenue to cross $316 billion. Earnings per share is projected to grow another 55% as margins expand due to higher average selling prices on the B200 and B300 Blackwell racks. The confirmed $500 billion order backlog stretches through the end of 2026. This includes committed orders from Microsoft, Meta, Google, sovereign AI nations, and newly approved H200 orders from China. The demand curve has also shifted beyond just large language models. 2026 is shaping up as the year of physical AI, powering humanoid robots and autonomous industrial systems. NVIDIA's Project Groot and Jetson Thor computers are seeing explosive demand from the robotics sector, creating a separate revenue stream that didn't even exist in 2024. Before I get to the number one stock, make sure you share this video with anyone you know who's serious about investing in 2026. These insights could genuinely help someone in your life make better financial decisions. Stock number 5, Meta Platforms, the AI advertising monopoly. The top opportunity I'm watching for late January 2026 is Meta Platforms. This is setting up to be one of the most explosive opportunities we're going to see this year, and here's why. The stock has consolidated recently, but it's quietly built tremendous momentum. Rosenblatt just issued a massive upgrade with a street-high price target of $1,117. This isn't about social media anymore. Meta has successfully weaponized AI to monopolize small business growth. Their acquisition of Manus, an agentic AI platform for small and medium businesses, signals that Meta is locking down the next decade of automated commerce. They're effectively creating a self-driving revenue machine for millions of advertisers. AI-powered ad tools are already hitting a $60 billion annual run rate, and ad prices are surging 10% due to superior targeting. Meta has rebuilt the moat that Apple tried to destroy with iOS privacy changes. Buying in the January 2026 window puts you ahead of the Q4 earnings print, where the market will likely be forced to re-rate the stock from a social media giant to an AI industrial powerhouse. There's another critical detail most people missed. The recent $16 billion tax hit on their most recent earnings staggered the stock price growth. That was a one-time deal. This next earnings, if they meet or beat expectations with strong future guidance, there will be no tax hit, which is likely what big institutions are waiting for. Multiple firms are bullish on Meta, Rosenblatt reiterated buy at $1,117. Baird, maintains buy with a target of $815. Wedbush has outperformed at $880. Bank of America is at $810. Morgan Stanley shows overweight between $750, $800. Piper Sandler maintains overweight at $840. UBS has a target of $915. Jefferies is overweight at $910. These price targets are significantly above where the stock trades right now. The numbers prove Meta isn't just growing, it's accelerating efficiently. For Q4 2025, Meta projects revenue between $56 billion and $59 billion, shattering previous expectations. Analysts expect Q4 revenue to hit $58.44 billion, representing massive 20.7% year-over-year growth. In Q3 2025, the average price per ad increased 11%, proving advertisers are willing to pay more because Meta's AI converts better than anyone else's. The company's AI-native advertising tools are generating revenue at a $60 billion plus annual run rate. That's effectively a Fortune 50 company inside Meta purely from AI updates. The Manus acquisition announced in December 2025 gives Meta a monopoly on agentic AI for small businesses. This is expected to open a completely new SaaS-like revenue stream in 2026. By 2026, Meta, Amazon, and Google are projected to control over 56% of all global ad spending. Meta is eating market share from smaller players like Snap, Pinterest, and TikTok who cannot afford the AI infrastructure to compete. Despite being labeled part of the Magnificent Seven, Meta trades at a reasonable 24x forward PE ratio, significantly cheaper than many tech peers, providing a safety margin for buyers entering at current prices. After heavy investment cycles in 2024 and 2025, 2026 is projected to be the year where CapEx stabilizes and free cash flow explodes, likely leading to increased dividends or massive share buybacks. Final thoughts. These 5 stocks, Oracle, Shopify, Sophie, Nvidia, and Meta platforms represent what I believe are some of the most compelling opportunities as we begin 2026. Each one has unique catalysts coming up in the near term, strong institutional support, and business models that are positioned perfectly for where the market is heading. The key is understanding not just what these companies do, but why their timing is so critical right now. January often sets the tone for the entire year in the stock market, and positioning early in these names could make a significant difference in your portfolio's performance over the coming months. Stay informed, stay disciplined, and most importantly, make decisions based on solid research and your own financial situation. This is Finance Hype, and I'll see you in the next one.